Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor on the West Coast. And I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks, everybody, for watching and listening.
Great to be here as well. So one of the phrases my wife and I have found we've been using with kids recently, we've been doing some long summer car rides from the Bay Area down to Southern California, and kids ask lots of questions. And since we have the time in the car, we usually start off with something along the lines of, like everything else, it's complicated. And then we explain all the nuance of the conversation. So when Trishul told me about a mutual fund case that he was into discussing, that was the first thing that came to mind. It's like, well, it's complicated. So today we're going to spend probably an hour-ish getting into all the nuance that makes mutual fund, especially mutual fund share classes, complicated. But to help set the stage, Trishul, do you mind kind of describing the client case that you are working on, and we'll use that as our springboard to go deep into mutual fund share classes, advisors versus brokers, commission versus fee, et cetera, et cetera, et cetera.
Yeah, happy to. So it's not a terribly nuanced situation, and it's completely ordinary in terms of what we might see. The notion is new client that came on, they have an existing portfolio. They didn't just show up with a bunch of cash, right? And their previous portfolio was managed by a third-party firm, and the investments that the portfolio had allocated for this couple across a handful of accounts were mutual funds. And those mutual funds, which might be, part of the topic of this conversation, had different share classes assigned to it. So that's kind of the starting point in terms of, okay, here is where we are. And then, part of the process with working with me is figuring out, okay, where do we go from here? And then how do we get there as sensibly as possible?
Okay, so do you want to explain two things? One, what you are actually doing for the client, and then two, a quick primer on what are different mutual fund share classes.
Yeah. Okay. So the first question in terms of what are we trying to do here? Well, part of the engagement, with working with me is we're working on two core areas. One is the financial planning side, meaning what are all of the life goals and how do we meet them without ever running out of money over the course of the projected, life of the two clients. And on the investment side, well, for all those goals, we're going to have to save and put those funds to work in a sensible manner so that we maximize our chances of meeting all of those goals. So that's the investment management side. Mm-hmm. So a good part of the early work we were doing with the clients is, figuring out, okay, well, what are the needs? What are the end goals of the funds that we are going to be working towards saving and growing? And again, that's more financial planning work. The idea there is we want to figure out what are the retirement needs and what are the, the education needs and the insurance needs and all of that along the way. And then once we have some notion of that, then we want to transition to the investments and think, okay, so now we have a certain starting point and we want to understand how we want to invest these funds in a sensible way. That involves just an assessment of the client's situation in terms of their desire to take on risk, their ability and how much risk they need to take on, things like that, and devising a portfolio that might make sense for their situation. So now we're at the point where, okay, we have a portfolio that we think makes sense. We have some notion of how much they need to save in that portfolio over time to meet their objectives. And now we're looking at, okay, well, here's your existing portfolio that you've built up so far. That's our starting point on, the looking at the investment accounts. And we know what the end point is. We know the transition point of where we want to get to with the portfolio, meaning we have a portfolio in mind that's risk aligned with the client's objectives.
Mm-hmm.
That's in my case, it's passively managed or a passive portfolio of index funds, ETFs specifically. And then incoming, we have these mutual funds, which are more actively managed. So that's a transition that we're thinking about. And along with those actively managed mutual funds, there's different share classes we want to consider. The share classes are tied to each mutual fund, which delineate essentially the compensation that the previous advisor was getting for each of the mutual funds. And that involves the fees. And the fees have different structures. That's where these different classes come into play. Class A, B, C are the three main ones that we typically see. And yeah, so the high level distinction is when you enter a mutual fund, if it's a class A, typically what that means is it's a front loaded mutual fund, meaning you'll pay a high fee to get into that fund. And then you'll pay a smaller fee on a go forward basis.
Okay.
So that's the class A. The class B is a back end fund, meaning you won't pay a high fee to get in. You actually pay the high fee to get out. So you'll still pay a marginal ongoing fee, but if you want to ever get out of it, you'll have a big back end fee. And there are many caveats to all of this in terms of how high the fee is and if the fee steps up or down, depending on your holding period and whatnot. But so far, let's just stick to the simple case. You want to get out of a Class B fund, you'll probably pay a big fee. That's kind of the point. And then the Class C fund is instead of paying a front end fee or a back end fee, you'll just pay a more moderate annual fee for just staying in the fund over the life that you're in the fund.
Okay.
Again, millions of caveats to all of that, but maybe that's the post-it note version.
I think the few caveats I want to add. One, we'll say with the A shares, for example, that front end fee is about 5% of your total investment. So if you're putting in $100,000, your front end fee is about $5,000. You're paying that to the advisor, and you'll have $95,000 invested. Then for our example, what is the thing? I'm trying to think of a good example of an A share expense ratio ongoing. 20 years ago ish, maybe 30 years ago, an actively managed A share might have an ongoing expense ratio of about 1%. That's kind of an actively managed mutual fund expense ratio 1%. A B share would be a higher annual fee. Let's say it's 1.5-ish. Again, it's actively managed, same investment strategy. You don't pay that 5% up front, but it's something like 7% if you want to get out in the first year, and that slowly goes down from 7 down to 1 down to 0 over about 7 years. And after 7 years, those B shares would convert to A shares. So higher fee for the first 7 years, and then it gets out, and then it converts to that lower fee. And the C share would be, let's say, for example, roughly 1% higher. So it would be 2% ongoing every year. And the super quick math was, if you are going to buy and hold this investment for a long time, A shares had the lowest cost. Even with that upfront hit, the lower annual cost would pay out over, especially over a 7+ year time frame, 7 to 10 years, or hold it longer, A shares would pay out. But people don't like paying that upfront cost, and so B shares became easier to sell. Like, okay, you don't have to pay that money out of pocket, but the mutual fund companies and the advisor would make it up over those next 7 years, and you'll get to those A shares eventually. And they were easier to sell. And then C shares were ongoing. It was like, it became a different way to sell them, and we'll get into advisor incentives in a little bit. But it was an ongoing fee, no upfront cost, no back-end cost. But it was consistently about 1% higher. Is that good for the caveats?
Yeah, that covers a good amount of things. You can imagine part of the goals of the different share classes are slightly different. For example, the A shares, the goal is if you're going to be in it for a very long time, maybe it's okay to pay that high upfront fee, because after that you're going to have a lower fee from that point on. And if it's like a buy and hold type of strategy, maybe it'll be okay in the long run. And the C, just kind of has a higher moderate fee just kind of all the time. So maybe if you're going to be switching out of it sooner rather than later, it might make more sense under certain conditions.
It does give, you're right, it does give you more flexibility to change funds if you think that a different fund is going to perform better, or you want to rebalance from a U.S. stock mutual fund from one fund family to a international stock mutual fund and another fund family. Yeah, that kind of rebalancing C shares would probably be better for that kind of thing.
Yeah, so depending on your style, if you're kind of like a buy and hold, very long term, maybe the A's or the B's are going to be more sensible. But if you're going to be trading and being a little more opportunistic or tactical in your investing strategy, then maybe the C's might make more sense. The other distinction, which you kind of also highlighted, is what were the fees that you mentioned in that example for the A, B, and C. They had this notion of being actively managed, meaning the products themselves were actively managed, those mutual funds. So, I guess the other caveat I might throw in is you could get index funds that are mutual funds that are more passively managed, that have the A, B, and C shared notions in them, but it would just be similar in terms of the front end load, the back end load, or the no load with the C. Just your expense ratios would be lower in general for the passively managed mutual funds versus the active, because there's less actual management work going on within the products of the index funds versus the actively managed funds.
Okay, so I do want to get into history of mutual funds within the financial services industry, especially because we are going to need that to distinguish between the mutual fund product versus the active or passive investment strategy within that product. And we'll kind of get into mutual funds don't need to be actively managed. We do have passive or index mutual funds. And ETFs, actually now recently, aren't automatically passive, although that was their history. So like we'll get into that. But first, why were you converting share classes instead of just sell the mutual funds and buy the ETFs?
To be clear, we weren't converting share classes. We're trying to do the latter.
Okay.
The only reason I brought up the share classes is he had a mix, or this client situation had a mix of A and C shares.
Okay, I was trying to set you up. I was trying to like lob you a softball. With mutual funds, if you convert from a C share to an A share, that's not a taxable event. So if there's a capital gain in that C share, the fund has gone up, you can convert from C shares to A shares within the same fund family, and you don't pay capital gains taxes. Also, if you've paid an A share load within a fund family and you move to a different mutual fund within the same fund family, you don't pay that A share load again. So if you're using A shares, there was incentive to use one mutual fund family. So if you use American funds for your US, your international, your bonds, you could do an all A share portfolio, rebalance within that fund family and not repay that A share load. And that's where the C share idea kind of comes into play. Like, well, I really like American funds for their stock portfolio, especially their domestic stock portfolio, but I like Invesco for their international stock portfolio and PIMCO for their bond portfolio. And so if I want to use all three, well, I don't want to have to pay my A share load on my US stock, and then when I rebalance over to PIMCO, pay the A share again. So that's a way that the C shares did make sense sometimes if you were preferring to use different mutual fund families. But one of the reasons we would convert share classes within the same fund family is we can avoid the capital gains taxes of that.
Mm-hmm.
So does that kind of quick understanding, like C shares versus A shares versus B shares, and why you might choose A versus B versus C?
Yeah, I think we covered that ground. That makes sense.
Okay. So going back to kind of history, this is a lot of like late 80s, early 90s, like really mutual funds really came into play in the 90s. At that time, if you hired a broker, a stockbroker in the 80s, the stockbroker would say, hey, you should buy IBM. You should buy Coca-Cola. They're going to recommend a specific stock. And a good broker, because they only made money on the commissions from that actual order ticket. So then they call you up a few months later, hey, here's this other company, let's sell out of IBM and buy this other one. Or like, you know what, a really good broker, you've held IBM for a year, let's gone up, let's get those long-term capital gains rates and buy this new thing that'll go up over the next year. And the really advanced brokers had a diversified portfolio of 20 or so stocks that they would recommend, because they had analysts in their back office saying, hey, we like this stock, we like this stock. And then so you could call up, say, hey, I recommend that you should sell out of IBM because it's already gone up, so I can go down, let's go buy this other stock. So the way that the brokers were compensated was the actual order tickets, and you were buying individual stocks. You might have 20, I don't know if they could put together a portfolio of 50, but a diversified portfolio would be 20-ish stocks. And some of them would kind of include the capital gains information. There wasn't a lot of attention paid. They're like, oh, you got long-term versus short-term. But it was just kind of getting raw return with these concentrated stock portfolios. So mutual funds came in and they say, okay, instead of paying that broker an order ticket where the incentive for the broker is to recommend a new stock every time you talked, we're going to pool your money with a lot of other people, diversify across hundreds of stocks. Maybe they might keep it down to 50 or 75, but they're going to spend all the time doing research, and they get a better diversified portfolio, but still outperform an index. And we're going to charge you 1%. The manager choosing the stocks is going to charge you 1%. And then the advisor who is recommending this U.S. stock mutual fund, this other one, they will be compensated based on the share class. So the mutual fund manager actually doesn't care which share class or even know what share class that each individual investor has. It would be the relationship between the financial advisor selling the mutual funds or the investment manager that could have been a stockbroker, because they actually likely have the same securities license. They're selling a mutual fund. And, okay, we're going to be together a long time. Let's do this A share because it'll make more sense over time. Or I don't know if we have the relationship. If we're going to stick around, maybe do the B share, which doesn't cost you anything up front. We'll get into transparency of fees in a little bit, but they say, okay, all the fees are in this prospectus. Go and read that. Doesn't cost you anything up front. Like it's you can imagine it's an easier story to tell than the A shares. Of A shares, someone look for the state like, I gave you $100,000. Why does my statement say 95? Like, all I explained is that 5% A share load. Versus the next person, I gave you $100,000. I open my statement, it says $100,000. It's like, okay, I'm happy. Because they don't read the prospectus, because no one ever does. Also, this is kind of pre-internet, so investor education is a little harder these days. And then, so these were kind of the predominant share classes. Then when we get to the internet and more advanced research, we start to get like passive versus active debates. Can active managers outperform their 1% fee? And you saw this like beginning of, I don't want to say fee compression, but it's a consumers aware of the fees they're paying. There's enough research showing that If you pay higher fees, you have less money 20 years later. And so there was some lowering of fees, but there was a greater education around what am I getting for the money that I'm paying. And this is actually where financial planning started to come into play. Around, again, late 90s, early 2000s, advisors started offering more value. They actually started offering more services, usually in the form of financial planning, for that same level of fee. Again, if they were a broker, so they are what was a registered representative of a broker dealer, they're allowed to sell stocks. They have a Series 7 license. Series 6 could actually be sell just mutual funds or variable products. Series 7, they could sell stocks, individual stocks, or those mutual funds. They take one test and they can sell mutual funds, but now they're going to try to provide some advice. So now it's we're actually going to pay attention to your capital gains taxes. We're going to pay attention to your asset allocation. We're going to pay attention to the risk that you're taking on. It doesn't have to be an all stock portfolio. Even though you get lower returns by adding bonds to the portfolio, you actually get a better lifestyle outcome by not taking these big swings up and down. And so this was kind of the original part of financial planning, was not just stock return or even diversified stock portfolio return. It's now other considerations outside of just the raw gross return. And this is also where you started to see registered investment advisors, RIAs, and investment advisor representatives. So IAR is a single person who works for an RIA, and I apologize for the acronyms. Those are more industry acronyms, but we'll get to kind of where those come into play. They started doing more planning, and they started to emerge. And so you started to see this difference of, if you found someone who was recommending an A-share mutual fund, their incentive was to sell you that mutual fund. They didn't get paid on anything later on. So they didn't have that much incentive to maintain a strong relationship with their clients. Their financial incentive was to go out and find the next client and get paid a new A-share charge. With investment advisors, and we'll try and use that phrase instead of RIA or IAR, I'll try to use investment advisor as the person who is going to charge an AUM fee. This is where the kind of these really started to come into play of the individual advisor is going to charge a 1% assets under management fee. And in conjunction with mutual fund families and ETFs, so mutual fund families started to offer no load mutual funds, and ETFs starting to come into play. Your investment advisor, I'm going to charge you 1%. We're going to do asset allocation, but you don't have to stay with one fund family. I'm going to be aware of capital gains. We're going to try and sometimes do active strategy, sometimes do passive, but now we can do any mutual funds. But my incentive as the advisor now is to keep the client happy, because I make money based on the long-term ongoing relationship. And that's where the kind of the financial planning idea came into play. So consumers, they like this, like, oh, I can either I understand the A-share is the lower cost, but there's no incentive for the advisor to actually provide any good work for me. They just make the sale and move on. The B shares just cost more for the same incentive. I'm going to choose an advisor who will be there with me along the way. And you start to get a lot of the financial planning help of making better decisions that do compound over time. And there was research in terms of, Vanguard kind of dubbed it gamma, of kind of the advice that advisors provide along the way from a decision-making perspective did tend to outweigh the 1% AUM fee, depending on a lot of assumptions, whether it's taxes, because it's hard to kind of figure out a counterfactual, like what would that individual have done without the advice from that investment advisor. But they made some assumptions that seemed reasonable and did show that advisors do provide value to clients. And the trying to quantify that was difficult, but there's reason to believe that there is value there. The broker-dealer community saw the business perspective and the business value of the RIAs, the investment advisors. They saw that people liked that incentive to keep the client happy and do good work and be rewarded over time. So they started selling C shares more, where you're kind of getting the same cost, same structure, same incentives. The investment advisor, again, I'll use our active managed mutual fund at the time, because again, passive is still debatable. It's not prevalent like it is today. Internet is still new, so there's still a lot of investor education to come over the next couple of decades. So from a consumer perspective, they could see investment advisor is going to do the 1% expense ratio of the A shares, because mutual funds were now catering to investment advisors and say, okay, we can waive that A share charge, because the A share charge went to the advisor. The mutual fund company never made money on the A share charge. That always went to the advisor. And there's like, we'll get into like, as now I'm going to get today, like the difference between like firm compensation versus individual compensation. That's a different discussion for a different day. But it went to the advisor, that advisor's firm. And so the mutual fund company had no problem giving you A share expense ratio and not charging that A share cost. And the investment advisors do that. Thought like, we'll get that lower expense ratio mutual fund, not going to charge you the upfront cost because you're going to pay me directly that 1% per year. And this was the first time that there was at least some transparency in terms of fees up front. Clients knew they were paying their person, their advisor, 1% of their assets ongoing each year. The broker-dealer community, so again, this would be registered representatives. They work for a broker-dealer. They have a Series 7. They could sell now Class C shares, which would do that 2%. They would do that. Sorry, Siri's interrupting me. They would do that 2% ongoing annual fee. 1% goes to the active manager. 1% goes to the registered representative selling it to them. And again, it's now getting very, very similar fee structure, very, very similar total dollars paid by the client, very similar incentive structures. So consumers and clients, they kind of didn't care. They didn't notice it. Like, what's the difference between paying 2% to the mutual fund company, and that's how my advisor gets paid, or paying 1% to the mutual fund company and 1% to the advisor? Like, both add up to 2%. They both provide the ongoing value that I want. That for most people, especially in the early 2000s, those were kind of indistinguishable. So far, okay, do I still have you? Like, is that too much, or is that a good primer of like, we got to the early 2000s, active versus passive is still debatable. Like, there's not enough academic research, but from a business perspective, both high level and down to the individual level, they're kind of the same. Similar incentives, similar costs. Does that make sense?
Yeah, so the overarching trend is there's a couple themes of evolution going on over this time period. The initial theme is, how does compensation happen in general initially, and how does that evolve over time? So you have these investment professionals who are providing some sort of guidance on what to invest and why to invest and how long to invest and so on. And they're hoping to get compensated, right? So that's part of the initial commission structure that was set up with the brokers and the clients. And that's where we kind of started. And then it transitioned to having a separation of of powers between the investment decision and in terms of what to invest in, and then applying that to which product to apply to a given client situation. So that differentiation was basically the mutual fund wrapper, where inside of the mutual fund, you have professionals figuring out what are the best investments to place in that mutual fund. And then you have the investment manager who works directly with the client to figure out first which mutual funds makes the most sense for this client.
Mm-hmm.
And now that you figure that out, okay, now which share class, would make the most sense based upon the client situation. So that kind of, yep.
Okay, so your first part is right on. It's now, how is a regular person going to pick the mutual funds? They have no idea of, like, this is, again, Bogleheads doesn't exist, websites don't exist. Like, they need to find a professional to just help them choose the right mutual funds. And the professional will start to like, oh, this mutual fund manager has shown success with U.S. large cap. This other one's shown success with U.S. small cap, international, domestic bonds, corporate bonds, muni bonds, etc. And so the investment professional working for the client is going to help them choose the mutual funds. The second part was wrong, but I already forgot what it was.
Well, I want to highlight this other theme, which may hopefully fill in that gap. So another theme that we kind of saw is initially it was really about the investment side of the equation, the investment management, the investment picking, the stock picking, and so on. And the financial planning was either not existent in that relationship or it was very rudimentary. So another evolution that's gone on over this early part of the financial industry is this notion of, okay, but there's more than just picking the investments. There's all of these planning issues that might come up along the way, because that's the main driver initially of why we're making these investments to begin with. We want to save for retirement. We want to do all of these other things.
So I remember why the other one was kind of incorrect. The choosing the share class idea was almost never like for the benefit of the client. It was almost entirely determined by how that advisor was registered. Were they an investment advisor representative under the SEC, or were they a registered representative under a broker-dealer, which was under what was the NASD combined with the New York Stock Exchange to create FINRA? So there were two different regulatory bodies that, if you were a registered representative, you would do the C shares. If you were an investment advisor representative, and that's why I say investment advisor, you would do the 1% A shares plus the 1% AUM fee. So that's why I say it was not after choosing the right mutual funds, then choosing the correct share class. It was depending on how the actual professional was registered, determine which ones they could offer.
Right. So I guess the way that ties in is initially it seems like it was really more about the investment choices and less about the planning and the advice that would go into
Correct.
it.
Yes.
And therefore, the evolution or the transition to more of the C classes being, I guess, more common is the idea that maybe more emphasis should be allowed to be placed on the planning side of the equation. And to allow that, you have... I'm also hedging here because let me finish this thought and I'll explain why I'm hedging as well. With these maybes and kind of should have. Because, the C class, as you alluded to, allows for this ability to have some sort of distinction between planning and actual investment management.
And technically, no, but go on.
Well, the reason I say that is because you have the 2% fee in both cases.
Yes.
Where you have the 2% embedded in the mutual fund, or you have the 2% as a 1% split between 1% going to the advisor, 1% embedded into the mutual fund expense ratio.
Yes.
that transition to that second case is hopefully trying to create a little bit more of a distinction in terms of, okay, that 1% include that goes to the advisor is also for helping out on the planning side of the equation beyond just the selection of the mutual funds.
Yes.
Now, the hedging that I'm trying to put into this is a lot of this deals with this notion of commission from the beginning, meaning you're getting paid to recommend products, and that's where the compensation comes into play.
Yes.
And that on its own leads to conflicts of interest of even choosing A, B, or C. For example, an advisor might want to steer, or sorry, an investment manager might want to say, hey, these C shares are great, but hey, I found another C share that's even better the following year, right? Or another A, sorry. These A shares are great and you're already in it, but here's another A share that I found that really makes a lot of sense. By the way, I get a 5% commission just by transitioning you from this one to this one. So
correct.
There's some conflict of interest on trading too frequently between these different products, where if you're in the A, you could rack up a lot of money as an investment advisor by allowing somebody to move too quickly from one to another over time. So that's a conflict of interest. I think that's part of why the separation is starting to grow within the industry.
I'm going to say no.
Well, here's why I think so, and I'll let you. I'll turn it back to you on the no, because I think there's been some sort of understanding, and the third theme that I see is this transition from active to passive, which we'll touch upon in just a little bit.
Yes.
And the fourth theme that I see is this transition from mutual funds to ETFs. And I think they're all connected to this notion of putting in a more stronger focus on the planning side and not solely being focused on the investment side. So initially, I think a strong focus is investment, meaning if today we have like a 50-50 split in terms of the importance of investment management and financial planning. The initial investments were, the initial relationships were far more investment focused and less planning focused. And I believe the secular trend of giving more focus to the financial planning is a part of why we have these theme transitions from the fee structure changes, from the active to the passive, from the mutual funds to the ETFs. I'll turn it back.
Okay. So, I think you're right in general. Like all of those things happening are all interrelated.
Yeah.
Okay. The it's complicated part. And this is still a concern today, but you're getting to like consumer demand and trends from businesses to provide what the public wants versus regulators keeping up with that. So in this particular instance, investment advisors, so again, RIA, registered investment advisor, and IAR, investment advisor representatives. RIA is the company, IAR is the person. Because they are registered with the SEC as investment advisors, they can charge the 1% to provide advice. That's the advice includes choosing investments. The advice can also include all the other financial planning things outside of investments. That is one of the regulations that they're allowed to do for that 1% fee that they're charging. The broker dealers and registered representatives started using C shares from a business trend of people like this RIA model, this fee model of charging fees for advice on both the investments and outside of it. There was enough consumer demand for that model that the registered reps started using C shares to mimic that model. The cost is the same, the incentives are the same. The big difference is that registered representatives can't legally give advice. This is an SEC versus FINRA rule kind of idea. FINRA is a self-regulatory organization. SEC is a governmental organization. There are also a lot of RIAs that are registered under individual states. Just smaller RIAs are registered at the state level rather than the federal level. But they're government organizations. FINRA is not a government organization. There is language in the broker-dealers rules that they can provide advice if it's incidental to the sale of an investment product. And like, yes, this retirement account will grow. So you need to understand how stocks work and how stocks grow. So why this stock mutual fund will grow more effectively than a bond mutual fund when you're still 30 years away from retirement. Mm-hmm. That is advice incidental to the sale of the mutual fund.
Yeah.
But a lot of registered representatives are providing advice on mortgages and taxes and other things that it's really, really hard for consumers to tell the difference. They're paying the same amount. They all call themselves financial advisors. And like, no one looks up if they're registered under the SEC, the state of California, the state of Florida, or FINRA. And they're Series 7 or broker deal. Like, there's no way for the regular public to know the difference unless they're like going so far into becoming an advisor themselves that like they could probably do it themselves.
Yeah.
So that is one big
complicated bucket.
Oh, okay, hold on. We're not even close to it's complicated. The next layer of complication is that individual people can work for both a broker-dealer and a registered investment advisor.
Right.
They can be both a registered representative of the broker-dealer and sell that A-share mutual fund or the C-share if they want. They can also be an investment advisor representative of an RIA and charge a 1% AUM fee. Now, pretty strong trend. So like when you talked about that sold an A-share, like, oh, here's a better mutual fund over here, sell out of that A-share, buy this other A-share. Yes, that did happen, but there were enough kind of like market trends and incentives. Like no one wanted to pay that A-share twice within 2 or 3 years. So you had to have a really good incentive, really good reason to move there. So that didn't happen that much unless it was like a combination of a shady salesman and a gullible consumer, which there's actually a lot of. And so there's a lot of regulation is designed to protect that, especially for older consumers that maybe don't have the time, energy, and or mental faculties to assess that. They have the money and the dementia to be taken advantage of. So a lot of regulations are in place to protect them specifically. So that did happen, but not as much. But it does happen that, okay, I'm going to hire my advisor. I like this person. They are registered with the SEC, so they're giving me advice, but they're getting paid from the C shares. And that gets really complicated. So yes, that person today could choose, do we do the C shares or the 1%? And the biggest difference would actually be the transparency of it, where with the investment advisor, the client signs, yes, I'm going to pay 1% of my assets under management calculated or divided by 4, calculated quarterly. The other one says, I'll buy the mutual fund. Mm-hmm. And like, there's no disclosures that they have to sign off saying, yes, I know the expense ratio of the mutual fund. They have to provide a prospectus, and the data is, and the information is in that prospectus, but so is 50 other pages of legal information that's so boring that no one ever reads it. And so that ends up being one of the big themes now, is with commissions, the amount going to the advisor is not transparent in a way that it is for fees from investment advisors. And so related to this, especially now the internet has kind of, now we're like mid 2000s, 2010s, like especially post 2008, we start seeing more ETFs. So that there's been a strong growth of, hey, I like paying my advisor 1%. I don't need to pay the mutual fund company another 1%. I love this idea of paying my advisor 1% for all the other financial planning work I get, and paying the mutual fund company like 20 basis points, 0.2%. And then over the last decade, it was gotten pretty close to zero. In fact, there are some that are still zero, but we don't recommend those for lack of flexibility reasons. You can't take your Fidelity Zero fund and move it somewhere else outside Fidelity. You're stuck with Fidelity, which we'll get into. We might get into cash sweeps later. But consumers, like, I like this idea of paying my advisor 1% because I get a lot of value. Like, that generally improves my life, and let's keep that investment cost low. ETFs did a much better job of this, of passive index strategy, really low expense ratio. And so RIAs, especially late aughts, early tens, were doing a better job of this than the registered representatives in the broker-dealer community. And so, again, mutual or investment or financial services companies responding to business trends, they start offering index mutual funds, where now the registered representative can sell the mutual fund that still has that 0.15, 0.2% expense ratio. So again, from a client or consumer perspective, it's hard to tell the difference between a registered representative charging an index mutual fund C share. So it's like, again, it's like a total of 1.2%, 1.3%, and an investment advisor charging 1% plus a 0.2% for the investments. So it was ETFs, they've been around, but they started getting popular once investment advisors started getting popular, where now we're just, like you said, that distinguishing the separation of the actual stock selection. So that was the active versus passive. We had active managers who paid 1%, or we can do just mirror an index for 0.15, 0.2%. We're separating that from the financial advice and the financial planning work that we get from the person who knows our lives. And so that's where ETFs filled that space really, really well. Also, we start to get, like, again, the internet allows for better consumer research. We start to see academic research on the impacts of fees on investments. And so it was a lot of RIAs using ETFs, and then mutual fund companies start offering index mutual funds, which registered representatives can use to, again, say, like, looks like the same total cost and same incentives to the person that you're hiring. So index mutual funds definitely emerged over the last decade, 15, 20 years, as a response to ETFs becoming more popular. And so even right now, you could hire a registered representative, use the C shares, and still pay the same as if they're hiring Trishul. And the it's complicated part gets really down to, why did Trishul and Aaron choose to be investment advisor representatives when they could have been paid the same as registered representatives of a broker dealer? And so I'll let you kind of fill in your understanding of that difference, and I'll then add mine.
Yeah.
So first, I guess, like, anything you want to add or clarify on where we are today in terms of mutual funds, ETFs, IARs, registered reps, active, passive, anything like you want to. I had a lot of, like, 6 or 7 layers of complication there.
It's quite the evolution we've seen with many trajectories. I think I do give some credit to Jack Bogle, the founder of Vanguard, for being a big push on the passive front.
Mm-hmm.
So he created the first passively managed fund, mutual fund, with the S&P. They're passively managed. I believe they were tracking the S&P initially, but basically this was, oh geez,
Like late 70s, I think.
Yeah, it was in the 70s. Yeah. And the notion there that he put out is, you don't necessarily need to pay for an expensive fund manager to pick the best subset of the S&P 500 that's going to outperform the S&P 500 if already there was plenty of academic research that said, hey, if you just held the S&P 500 itself in their correct proportions, you have a far greater statistical likelihood of doing better, because that can be done without paying a professional tons of money to figure out that subset that could be better than the rest.
Like we can go back farther. I think Harry Markowitz and modern portfolio theory, his research was in the 50s. And so this idea that like asset allocations, 91% of your return, stock selections like 8% or something like that, and timings the other 2 or something like that, goes back to the 50s. But we also get into that, well, where's the incentive to inform the consumer of that? Because none of the mutual fund companies are going to spend any time or energy broadcasting that information. And not a lot of people are reading academic journals. So that's another like pre-internet versus post-internet kind of thing. But yes, the I also completely agree that Bogle in the 70s creating Vanguard was like 2 or 3 decades before the rest of the world caught up to him, kind of thing.
Yeah, and I think it's one of those things where, looking back, it's hard to say where the pushes actually came from the consumer, from the marketplace, from guys like Jack, or academic research and stuff like that. But the good news is we've come a long way, and I think we've headed in a direction that provides more value for the client. And I'll highlight just an example. It's something that I Googled right before, looking at some of these fees as a comparison to what I might recommend today, and why I would choose the path that I chose, Aaron, as you mentioned, versus all the other alternatives. So let me just share the screen here, and then we can kind of show a real-time example. So, first we'll look at a actively managed balanced fund, I guess.
Okay. So like what I still recommend, if friend says, hey, I just got to get started, what's the easiest way? If they don't want to, sometimes like a Vanguard total stock market index and total international stock market index. That's two things that I need to look at. If they just want one, a lot of times I'll just recommend Growth Fund of America. I think that's still a really good diversified all equity mutual fund that's really easy for people to get started with. And like that's one of the simpler things for it. If they don't want to like go to Betterment, go to Wealthfront, like learn anything at Vanguard, like we've got to get you started somewhere. And it still has done a great job of being really, really aggressive and not necessarily outperforming, but combining equities enough to get good growth.
Right. So I'm just going to pick a actively managed balanced fund, class A. Let's see what Google says is the first one.
Actively managed mutual fund class A. Okay. I'm going to wait, hold on. It would have been like Fidelity had the biggest fund for a long time. It was Fidelity Magellan Fund.
Okay, here we go.
Fidelity, like I think they actually closed it. They had to create a second one. But yeah, Fidelity Magellan was like the best equity mutual fund for 20 years or something like that.
Okay, here's the Magellan Fund. Here we go. FMAGX. Okay, I got to show it to you guys if you want to see it. Here we go.
So this is a bad example because this was now a no transaction fee fund. So, but we'll take a look.
Yeah, that's okay though. So a few things. So one secular change that we've seen is, transaction fees themselves to trade into and out of these products. There has been a race to the bottom, for transaction fees. I think, was it Scott Trade initially that said something like $7 trades, right, way back
so
in the late
you start to get into like buying ETFs functionally the same as buying stocks, and so the exchanges still had to charge something for each order, and it was do the investment advisors kind of eat those trading costs or pass them on? Like that was still could have been gone either way. Whereas mutual funds never had those same like the trading costs were different. Like because you're purchasing into the fund and they're taking care of the processing, it was possible for them to waive that A share load and make it so there's no transaction fee to get in and out. Now they only make so there's still plenty of transaction fee mutual funds. A share, B share, C share. This still exists. They'll have a lot of money. But if you're looking for a new investor, choosing the no transaction fee means that you're only paying that expense ratio. So that's a clarification that's emerged over the last decade.
Right. Yeah. So, way earlier in this conversation, we basically started with individual calling up his stockbroker, and the stockbroker recommending stocks. Again, the way the stockbroker got paid was from these transaction fees. That was the commission, or part of that was the commission that funded this whole process of getting advice on what to invest in. And today, there's been this secular change. Scottrade put a lot of pressure, and earlier discount brokers put a lot of pressure to lower these trading fees. I think the next major shift was like like a couple years ago, they started to see a big introduction of no commission trading, right? Was it what was that firm that does that? Robo?
I honestly don't know, but everyone was like going to zero. Fidelity,
basically
Schwab,
a race to the bottom. So these days you probably shouldn't be paying anything to trade in and out of investments.
Okay, at the end, I am going to have to explain how Fidelity and Schwab make money, but that they're not making money on trading costs. But go on.
Right, they figured out a way for sure. Okay, so to get in and out, there's no fees. Now, the expense ratio for the investment manager themselves for this particular fund is 0.52%. So this 0.52% is to fund the actual manager who is trying to or the team of managers that are responsible for overseeing the, however much is in this, $27 billion, I would assume. B, right? So they get 0.56% of that $27 billion as their paychecks to figure out what to invest to make sure that this does better than the S&P 500, for example. Now, this likely has different classes, I'm assuming.
That's why I wasn't sure. If it's a no transaction fee, it might not have different classes.
Okay, but if it was an actively managed fund, it might have different share classes, which would have
if you did that's why I brought up the American Funds Growth in America.
Okay.
If you do AGTHX.
Okay, here we go, Class A.
And compare that to GFACX.
Okay, another example, 0.6% expense ratio. This one is the benchmark also the S&P 500?
Probably. It's going to be an actively managed all stock portfolio because it also
it's a large growth. Sorry, it's in the name. Okay, so this is targeting growth companies in the S&P.
Yeah,
and it has about 240 billion under management, and it's charging 0.6%. It's a Class A, so it's a front load, meaning that roughly about 5%, we would say, to get into this. And then once you're in it, 0.6%.
Yes.
And then there would be different share classes that are similar. Oh, here we go. Here's a full table of all the share classes that are similar. And you can see they spawned
all the
off.
same exact fund. Just Yeah, all different share classes.
Different versions, yeah. And you can see you can have different permutations of front-end load or back-end load, or the expense ratio itself, which goes to the fund manager, and then the ongoing commission that would go to the investment manager who got you into this product is the 12B1.
So you can see that go down to GFACX that has the deferred load of 1%. So that's usually goes away after a year or two. If you hold a C share for 1 or 2 years, they no longer have that deferred load. But the 12B1, that 1% is what goes to the person who sold the C share.
Right. And you can see the expense ratio is about 1.36, and that's to the manager, again, or team of managers that's responsible for overseeing what goes inside the product itself.
Yeah. So theoretically, if you had comparing an investment advisor charging 1% AUM fee and using the A share, which has that 0.6, your total cost is 1.6%. And if you had a registered representative using the C share, your total cost is 1.36. It theoretically could be lower.
Mm-hmm.
And similar in both cases, the person selling the fund, the advisor, is making 1%. Right. Actually, with the A share, they're getting a little bit of that 12B1 fee as well. So that also, that 0.24, so go up one row.
Oh, sorry.
So they actually are getting a little bit more on the A share.
Right.
So in that case, what you might see is the advisor selling, the investment advisor charging 1% AUM fee. They might say, oh, I'm going to lower my fee to 0.75%. Knowing that this is the investments that they're going to use.
Mm-hmm. Yeah, so this is an example of a actively managed fund with a mutual fund with various share classes.
Yep.
So the analog to that would be a passively managed mutual fund with different share classes. And that's, I pulled that up earlier. Let's see if it's one of these. Okay, so here's an example of a passively managed index fund that's still trying to beat the S&P 500 or match the S&P instead of beat it this time, since it's passively managed. And it has a share class A. So again, 0.54% expense ratio. This in theory should be lower than the expense ratio for the actively managed fund, because again, there's less to do here for picking the investments. You're just following an algorithm. It's published. Everybody knows what the S&P 500 is made of. You just got to do that. It's a class A, meaning it's a front-end load. So we can see maybe a similar table below. Of the different options here, you can see 5.5% to get in, and then 0.54 expense ratio, of which 0.25% is the 12B1 fee or the commission.
Yep. And compare that to the C share right below it.
Yeah, and the C share below that, this says the C shared sheets. Oh boy, this says the C share sells she shells on the seashore with a deferred load of 1%, right? And then the expense ratio of 1.29%, of which you get a 1% 12B1 fee.
Yeah. So again, this is the mutual fund as a wrapper is different than both the investment strategy inside it can still be active or passive.
Mm-hmm.
And the share class is going to be different, but it is kind of, this is why I think we had a previous conversation, like at this point now, passively managed index mutual funds are functionally the same as ETFs. Especially like at a place like Vanguard. Like you can buy both the mutual fund version and the ETF version. And like you get into like small trading mechanic differences that for the vast majority of people just don't make a difference, don't come into play.
Right. So now let's compare the similar Vanguard passively managed index fund for the S&P.
Yeah.
Is that like VOO?
It's going to be like 0.04%. VOO, the Vanguard Total Stock Market Index.
Sorry, that's an ETF. What's the
Vanguard Total Stock Market Index
Yeah,
fund.
what's the ticker on that? I'm going to do the S&P just so the others were the S&P.
Oh, okay. So Vanguard did have its own index, technically.
Okay, so Vanguard, S&P. Oh, I found it. Here we go.
Is it
Okay.
VTSAX?
VFIAX.
Oh, that's the SP 500. Yeah. Good.
Okay, here we go.
Is my memory good on the Vanguard?
Okay, so here we go. Now here's the Vanguard S&P 500 Index Mutual Fund for investors, and you can see there's no share classes in terms of A, B, and C. They have a slight distinction in share classes between investors and at what they call their Admiral class and their institutional class. There's slight differences.
Admiral, I think the Admiral, it's like minimum investments, where you have to, the more you invest, the goes down just a little bit.
Yeah, I have that right here. So the investor shares, for example, the minimum is 1,000, whereas the Admiral, the minimum is 3,000, and your fees drop from 0.08 minimum to 0.04. So roughly, if you can get a few thousand in it, you can qualify for the Admiral, and then you'll just get the lower. And this is the share classes they essentially have. But you can see the fee differences between the three classes are 0.08, 0.04, and then institutional, if you have 5 million and above, is 0.01. So a stark difference from the Invesco and the what was the other one?
American funds.
American funds in terms of the actual fees. You can see it's much less in terms of the share classes. Let's see if they have that breakdown here. Here we go.
So, yeah, those three.
Yeah, so it goes from investor class is 0.14%, Admiral is 0.04%, and the institutional is 0.01%. That's pretty much as low as you could go without it being zero.
But Vanguard, Vanguard specifically does not offer any kind of A share or C share.
Right.
These are the only forms of the investment they offer. Fidelity makes a zero index fund that'll track total stock market, where it literally has an expense ratio of 0, but you can only hold it in a Fidelity account. So if you have the account opened at Fidelity and leave it at Fidelity, it has to stay there.
Right.
So if you ever try to move to a different platform, you would have to pay capital gains to sell out of that one fund.
Right. So for example, in terms of the evolution, then, like, for example, with my clients, I would very often recommend the ETF version of these products, and that's the VOO. So now this is the ETF version of, let's see if we can get the Morningstar. Okay, so instead of being a mutual fund, and instead of being active, this is a passively managed ETF from Vanguard that also tries to match the performance of the S&P 500. And it's a exchange traded fund. That's what the ETF stands for. So you can buy and sell this like you would IBM, right, on an exchange when the market's open. And the expense ratio for this is 0.03%, right? Regardless of you buy one share or a million shares. What you kind of get with this is a very low expense ratio. Again, you can trade in and out of this for kind of free, and you're paying 0.03%. So this would be likely what I would recommend to a client if they're going for something that they need S&P 500 exposure for.
Yeah.
So again, there's no share classes, so you don't have to worry about those types of fees. You don't have to worry about the 12B1 commission fees. You only pay the 0.03%, and the fees that you pay to me are directly from the client to me, so they're nothing to do with this actual product themselves, or they don't somehow get bundled to this product and then to me, essentially because I have a no commission model, meaning I'm fee only, which Aaron, you are as well.
Yeah.
And the notion there is, the final evolution or the evolution that we end up at where we are today is this notion of you can get your investment products, you can get them passively managed, if that makes sense. That's what I do for my clients. And you can get that at a very low fee with an ETF wrapper rather than a mutual fund wrapper that's traded on an exchange, so that you're not worrying about commissions or any other types of share classes.
Mm-hmm.
And you can get pretty much the same performance you would, if not better, because you're paying less fees.
Yeah.
And then you pay your advisor separately.
Yep.
is the current model.
My final kind of distinction when it comes to this is, again, when it comes to that registered rep under the broker-dealer versus investment advisor, it's something that clients never see. It actually comes from the regulator perspective of when I am charging fees for advice, when I get audited every few years, I have to show auditors and regulators that I am providing that advice. Where the registered reps and the broker-dealer, it's a suitability function where as long as it made sense at the outset, there's no regulatory requirement that they provide any following advice to that client. Mm-hmm. Now, there is an incentive to do so, because if they're not making that client happy, the client can leave and take the money out of the C shares. Again, as long as it's been more than a year, that CDSC, the contingent deferred sales charge, drops off. But so while there is the incentive for the advisor to keep the client happy, there's no regulatory requirement. And that's one of the things that I do think matters, that you and I, we have to have compliance procedures in place to show that we are staying in touch with all of our clients, to annually disclosing what our fees are, sending them proactively updates on our firm that include fee changes. And that, I do think it provides it's not just the requirement from my end, but I do think that there are, or if not already, is going to be more of a shift to consumers wanting that kind of transparency as consumer education just gets better. That they're going to want to know that, yes, I'm hiring an advisor and they're going to actually help me regularly over time. Mm-hmm. It's not going to be, it's probably the best terms. It's not going to be, I reach out to the advisor, which is the incentive for the registered rep. They're always there. It's going to be advisor reaches out to me. Mm-hmm. And that's where there's both an incentive and a requirement that you and I do that.
Right. Yeah. And I believe that, so the big issue that I think is swirling around in this side of the industry is that on the broker dealer side, they're not required to meet a fiduciary standard.
Yeah.
So
it gets really hard when they're both a registered rep and an IAR, of when are they acting under a fiduciary standard and when are they acting under a suitability or standard of, like, yes, this makes sense. And there's almost no way for individuals to tell the difference at any moment.
Right. Yeah. So of the three models we mentioned, there's a broker-dealer model where you're pretty much commission-based, and you can do some financial advice if it's incidental, right? It's one of
which
these
is
things
also really hard to enforce, but yes.
It's one of these things. It's very murky, but you can get similar type of advice, although really the compensation structure is commission-based. Mm-hmm. And the broker-dealer is required to meet a standard that's not at the highest level, not at a fiduciary standard, but something known as a best interest standard, mm-hmm. meaning the broker-dealer can put the client at the same level, but not necessarily ahead of themselves, meaning the fiduciary standard on this side of the spectrum, which Aaron and I are required to meet as a registered investment advisor, RAA, is required to put the best interests of the clients ahead of our own rather than at the same level. And then, of course, there is this hybrid notion in the middle where you can be half of either, but it gets murky because you're kind of accepting commissions. You're kind of could be accepting a planning fee. Who knows which hat you may be actually wearing at any given time.
So like realistically, I have not seen advisors who will charge a 1% AUM fee and then also do some kind of loaded mutual fund. I don't think there's anyone doing that. But I do see advisors who will take money out of their 1% AUM portfolio and use a variable annuity of some sort, which is another commission-based product. And so that would be a different conversation for today, but like at least you understand that's an example where they were charging 1% and then they sell a product and they get a big commission from the sale of that product.
Right. Yeah.
And so now it takes money out of that AUM pool, but understanding like they have different ways of deciding how that commission gets paid from that variable annuity that the client never sees. So they might see the total fees if they look deep enough, but they start to get really complex really fast, and it becomes a overall transparency issue rather than a kind of inappropriate issue.
Yeah. So the terms you may hear are, in terms of the compensation structures for these three different models, are commission based for the broker dealers. And then Aaron and I were on something called fee only, meaning the only fees that we get are not from commissions, but directly from the client to us. And then that hybrid in the center, the term you may hear is fee based, where it may be some from the client, some from commission.
Yeah, it realistically, I see most of the revenue of a fee-based RIA is from fees on asset management. They're getting 70 to 90%, depending on the kind of firm structure, with the last 10 to 30% being some combination of life insurance and or annuities. So this might have ended up being one of our longer ones on accident.
Well, we covered a lot, but we did some history as well. But I think the high level notion is there have been a lot of changes in the industry over the past generation or so, and I frankly think for the most part that they've been helpful to the end client, which I think is the most important.
I agree. I think that like you said, bogleheads and the internet and consumer education have probably driven a lot of this demand in expectations from financial services professionals, and for the most part they're stepping up to meet that demand. Like it's you no longer see anyone really attracting new clients if they're charging a 1% AUM fee and only looking at the investment portfolio. There's now an expectation that they're going to be looking at the rest of what's going on if they're going to charge that fee. So yeah, I agree. It's a good trend. We're still lots of positive growth ahead of us in terms of helping out consumers, but it, like everything else, it's complicated.
Right. Well, good stuff, Aaron. I enjoyed the conversation, and I hope everybody else enjoyed. If you did, do like, subscribe, and share, and spread the word. Thanks, everybody. Thanks, Aaron.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.